makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, standing in for Francine Lacqua. Here's what's coming up on today's program. A diverging picture across Europe as French inflation expectedly slows. Euro area CPI is up later this morning, the next piece in the puzzle for the ECB. Now the BOJ announcing an unscheduled bond buying operation after yields across the curve climb to decade highs around the world. Plus, deadline weekend, the U.S. government shutdown draws ever closer, while over in Detroit, the UAW could expand its strike against the legacy automakers. So a quick look at the European markets map as we really digest some of these cross currents you are seeing from around the world. But look, green on the screen across the board. But I wouldn't say a ton of momentum unless, of course, you do look at, say, the DAX, for example, higher by 0.7%. Now, look, a lot of the global stock market has been under quite a bit of pressure. So it's really no surprise you're going to see this kind of return into the equity market. And by the way, that is something you are seeing around the world for the last 3 Fridays, which I think is pretty counter to trend. Simply this idea that on Fridays, people usually cash out, go home, spend their weekends, revisit on Monday. Now we're seeing a different dynamic at play. That's the equity picture. Let's talk about the bond picture as well, because look, the Treasury sell-off around the world is really, really interesting, specifically when we look at JGBs, but also when we look at U.S. Treasuries. And there's an argument to be made that as we start to look at some of the spreads between Italian BTPs and German bunds, a lot of the price action is actually driven by the sell-off you are seeing in the U.S. And I think this chart really encompasses that theme well, because if you go out into maturities, the 10-year, the 30-year, that is where we are. The highest, by the way, going all the way back to not 2008, not 2007, but 2006, when we're talking about that potential housing bubble. And that is going to be crucial. Now, what are the ripple effects, especially when it comes to allocation? That's where we bring in the S&P 500, having their worst month yet of the year. Now, this makes a lot of sense. A 10% correction in the tech index, 7.2% from its peak in July. It only makes sense that you are now seeing a lot of the momentum come out of the market. Now, the big winners of that rally that we just saw are actually the ones taking the hits. But I think it's still pretty important to say, look, this is, at the end of the day, a technical correction that you are seeing in the market. And that is significant because it then incentivizes new money to enter the market after people think the sell-off is actually done. One part of the market that is not seeing that dynamic this morning is going to be in the sports sector. And again, as we digest all the geopolitics, we decide the monetary policy, earnings are starting to seep back in as well. Now, overnight in the U.S. session, we did get Nike numbers. They basically said, look, the inventory glut that we had, it is over. The margin story that we had, it's over. In fact, we're actually beating our estimates and having major profit in a way no one really expected, to the point that you're starting to see a lot of the green on the screen flow into a lot of the European names as well. Adidas, or Adidas, as I'm told it's pronounced, Puma as well, and JD Sports, all higher by, we'll call it about 6% on the day. That is very significant in terms of the global approach to retailers that have largely been hit in the last couple of years. So, of course, that's going to be a cross-asset story from around the world. I want to bring you some new analysis, some new data. Eurozone inflation figures hitting the terminal at about 10 a.m. London time today. We've already had surprise with the French CPI data this morning. Joining us now for more on this is Bloomberg European correspondent Maria Tadeo. Maria, what can we expect from Eurozone inflation reading today, and how key is it to the ECB's next rate decision?
Look, it's always important, and as you say, we are in countdown mode to that piece of data, which should hit in about an hour from now. And Kriti, we've had numbers from Germany, we've had numbers from France, which show inflation effect cooling for the month. That's also reflected in some of the core dynamics. So that trend should continue when it comes to the euro area number. In fact, economists now expect that number could be in the 4% handle. However, the outlier, and I want to pay attention to this, has been Spanish CPI. Of course, when you look at the numbers that we got yesterday out of Madrid, you saw that headline inflation actually ticked up. And a lot of that is reflected in an increase in the volatility that we see in the energy market. When you look at some of the data from the Bank of Spain, but also the Spanish stats office, they say really reflects a pickup in fuel. And the reason why I want to take my time from Spain is not that obviously this is my country and I pay attention to it, but it's also the dynamics that could affect headline inflation because of energy prices do pose another layer of complexity and another headache for the European Central Bank. Remember, they have been very focused on core inflation, but they target headline inflation, and that is the volatility that the head of the European Central Bank already alluded to, given the complex picture that we see on energy prices in Europe. Now, when it comes to the monetary policy, Kriti, you know very well the market is specific transition now mostly to this idea that the European Central Bank is done hiking and now we flip into higher for longer. So that is maintaining rates at a high level. The numbers from Spain, you could argue, do back that case. But I should point the head of the ECB, of course, Madame Lagarde, is already insisting, however, keep an open mind because both duration and level matters to the European Central Bank. As you know, they will meet at the end of October in Athens for another monetary policy decision.
A lot to digest for the ECB. Bloomberg's Maria Tadeo breaking it all down for us. I love the idea that Spain could be the canary in the coal mine for the broader continent. Let's explore that topic a little bit more. Joining me now is Katharine Neiss, Chief European Economist and Deputy Head of Global Economics at PGIM Fixed Income. Katharine, a pleasure to have you with me this morning. Look, it kind of feels like there's some counteracting forces here. Maria just talked about inflation coming down in the Eurozone. We know it's coming down in the United States and other parts of the world. Perhaps not the pace that we want it, but it is coming down. And yet you are seeing a massive sell-off in the Treasury market right now. Yields hitting multi-decades high around the world. Why?
So I think there's a difference here between what we're seeing in inflation, which is largely reflecting what's happened in the past. So these are these much earlier rises in energy prices that we saw finally working their way through core inflation. And that's why because of these base effects that we're expecting core inflation now in the euro area to come off. But it's very much a backward-looking picture. As Maria noted, we're seeing higher energy prices now. That could be affecting headline, but it's going to affect things like core and services price inflation with a lag. So what does that mean? Yes, on the one hand, some comfort that we're finally seeing core and services price inflation coming off in the euro area. But against a backdrop of ever-rising energy prices, I think there is an expectation here that that fall down over the course of 2024 could happen very, very slowly, very, very gradually, and mean that this higher for longer expectation actually gets realized.
Well, how does that then apply to the Bank of England then? It feels like they have a completely different set of expectations and almost a set of I don't want to say tools, but I want to say impact, I think, is a good way to put it. You used to be a member of the Bank of England yourself. Talk to us about how you apply what you just said specifically to this country.
Well, I think we have to remember that each of the central banks do have slightly different remits. They're all inflation-targeting central banks when we talk about the Fed, the ECB, the Bank of England. But they do have different remits. The ECB is really very focused primarily on price stability, whereas the Fed, of course, has a dual mandate. And I would say the Bank of England is probably somewhere in between. They are an inflation-targeting central bank. They remind us of that at every meeting. But it's always subject to supporting the government's economic policies. And I think they do have more of an eye on the macroeconomy in the UK. And the UK economy is visibly weakening. It's also facing perhaps more structural headwinds than what we're seeing in the euro area. And perhaps that is a factor behind their decision to hold at this point. And of course, rates, they did start raising rates much earlier than the ECB, and they're at levels that are higher than in the euro area. And so I think for them, they really want to wait and see how does the UK macroeconomy pan out? What does that mean for underlying inflation for the UK going forward?
You know, we were joking last week that we always call Jerry Powell the central banker to the world, and maybe Andrew Bailey should take that title, just given that he has been the first mover in so many different ways. Talk to us a little bit about the liquidity picture, though, because it feels like even though there are all these fundamental narratives, perhaps the idea of supply digestion, isn't being fully kind of rinsed out or fleshed out. Walk us through your take on the liquidity picture.
So I think this is a really great point because you know, we sort of feel like we're kind of near peak rate. Based on what we know now, we think that central banks are largely done. The bulk of these interest rates are behind us, higher for longer. Does that mean that we can sort of think monetary policy is on autopilot? I would say no. There are other bits of the central banking toolkit that could take on more prominence in the months to come, even against a backdrop where rates aren't changing very much. And we're seeing that, for example, in the Bank of England, where they're doing accelerated balance sheet runoff. There are rumors that perhaps the ECB is thinking about bringing forward the end of, PEP reinvestment. So all of this could create some bumps along the road as we continue to transition towards more normal monetary policy. And I think that's something that, we shouldn't lose sight of.
I think that's a good way to put it. Bumps along the road in terms of deciding the direction of the broader market. Well, Katharine Neiss, chief European economist at PGIM Fixed Income, stays with us. We still have more of her brain to pick coming up on the program. House Republicans release a stopgap bill as the U.S. government shutdown gets even closer. That story next. This is Bloomberg. The deadline to avert a U.S. government shutdown is fast approaching. House Republicans have just released a stopgap bill, but a last-minute deal isn't looking likely. Joining me now is Bloomberg's Derek Wallbank, joining us from Singapore on this topic. Derek, you've had decades of experience covering U.S. politics. Talk to us a little bit about what this bill might actually entail.
Yeah, so I've had a chance to read it. It's about 180 pages long. The headline of it, I would say, is very, very, very steep cuts to everything that Democrats hold dear in a government budgeting sense. If you Republicans have tried to take some things that they like off the table, say we wouldn't cut defense, we wouldn't cut veterans affairs, we wouldn't cut homeland security, border, things like that, wouldn't cut disaster aid. Other than that, 29.88% cut. Democrats aren't going to go for that. I mean, it's not rocket science me saying that to you. Democrats aren't going to go from that. And indeed, this bill wasn't crafted with Democrats in mind. The point of it is to try and get something on the board to increase the leverage position. This is exactly the same playbook that House Speaker Kevin McCarthy ran during the debt limit situation. Try and put something up, find that improves your leveraging position, go from there. Problem is he might not have the votes. Now, we're expecting a House Rules Committee to take up the way that this bill will be considered, the rule for this bill, at 8 o'clock in the morning, Washington time. Expecting votes somewhere around the 11 o'clock to 1 o'clock window, also Washington time. So for those of you who are watching in Europe, you'll see towards the end of your day kind of where this is looking at and what our weekend is looking for. Asia's going to wake up tomorrow and figure all of this out and sort of see where we are. But all signs sort of point right now to the idea that as Saturday turns into Sunday in Washington, we may have a red headline on the wire that says that there's been a funding lapse.
Where is the pain point here? Who actually gets hit? Who goes home?
Yeah, I think that your biggest pain point immediately is federal workers, especially the ones who are being told that they have to continue working without pay and we'll catch you up later, possibly. That, I think, is a pain point. But I also think that there's some other pain points. I mean, one that I would mention is some of the labor statistics that are being kept. You know, it's harder to do that. Who's essential, who's not. That's a potential pain point that you could see. I think the biggest one that's kind of overhanging over all of this is a sort of, I don't know if we'd call it a threat, more an observation from Moody's. Moody's is the only one of the big three rating agencies that has the U.S. at AAA at the highest, and they said that a government shutdown could be potentially negative for the U.S. because it would demonstrate that maybe it's got some governance issues that need to be worked through. And so if you saw that change, then you're talking about some potential difficulties there. Yeah. The longer this goes on, though, the political pressure increases. I think right now it's important, though, to consider Kevin McCarthy probably has the votes to extend government funding if he wants to put that bill on the floor. He's probably got the votes for it. But if he does that, he's going to catch so much mess from his right flank that he might have a problem holding on to his job. That's a fundamental conflict.
And to your point, he certainly has a lot to prove both within and outside his party. Bloomberg's Derek Wallbank, thank you for that update this morning. We still have with us Katharine Neiss, chief European economist at PGIM Fixed Income. She sticks with us here. Let me put to you what Derek just brought up. Moody's came out right in front, I believe at this time last week, actually, and said if there is a government shutdown, there is a real chance of a downgrade. The last time we heard something like that from its peers was in 2011, and it ended up creating this massive kind of influx into the bond market. Do we see a repeat of that come Monday if the government does indeed shut down?
Potentially, that's the sort of safe haven flows, as you say, that we've seen in the past. I think, looking at it from a European lens, it feels a little bit like deja vu. We've been here before. And I guess we can't forget, though, that the U.S. is an extremely important trading partner for the euro area. I think the good news is that generally when we've had this sort of experience in the past, the hit to U.S. Real GDP in the quarter that the shutdown happens tends to get recouped in the quarter that follows. So that's the good news. The bad news, as you were pointing out, is this reputation risk. And of course, it comes on the back of other kind of down-to-the-wire decision-making that we're seeing from U.S. policymakers. Definitely more fragmentation across political parties. But I think more importantly, what is this potentially a signal around, the fiscal risks in the U.S. economy? And this could potentially have big spillover implications, I think, for the euro area. That is certainly, one to watch.
In terms of the kind of transparency issue that we may foresee, this idea that we may not get payrolls numbers, we may not get the data that we need, everything gets delayed and pushed back further. How big of an issue is that from an investor point of view?
Of course, it's never good to be flying blind if you're a policymaker, and events are fast moving. That said, the fact that it's happening at just this moment in time when policymakers are signaling, for now the bulk of the interest rate rises are behind us. Now we sort of need to pause, see how the macroeconomy is adjusting to these higher rates in order to assess where next. Perhaps this delay is not going to be as bad as it might otherwise be, given that we are a little bit in a wait-and-see position. But obviously, policymakers are having to make really important judgments as it is, and so at the margin, this is not helping.
Well, from a political perspective, it feels like this is being closely watched in terms of the players, simply because of a kind of early indicator of how even 2024 and the election might play out. In the bond market, is it too early to start pricing in some of the changes and developments going into next year's election?
Well, bond markets are very forward-looking, so I don't think it's too early, and there will be judgments that need to be made about a range of scenarios. And I think that is one of the real difficulties right now, is that you can see two quite plausible scenarios at opposite ends of the spectrum when it comes to what that means for the bond market. It could be that this wall of pain from higher interest rate rises is just about to hit. I'm thinking in particular in the euro area, and these hints of weakness are really going to start to gather pace quite quickly. Versus a scenario where actually governments are still supportive. We're seeing a lot of unspent investment money that was agreed during the pandemic, both in Europe and in the U.S., and that should help to underpin some of the cyclical weakness. So things could kind of go either way, and once you average those two things out, that sort of leaves you in the base case, which is we are where we are, and we're probably going to stay here for quite some time, unless things start to evolve in a very different way going from here.
Yeah, and it looks like that volatility really going to get amped up. I think we showed a chart that shows shutdowns are met with volatility anyway in the bond market, at least for a little bit. Katharine Neiss, Chief European Economist and Deputy Head of Global Economics over at PGIM Fixed Income. We thank you for your analysis this morning. Coming up on the program later this hour, we'll hear more from BlackRock CEO Larry Fink after the Berlin Global Dialogue. We get his prediction on whether the U.S. economy will indeed enter a recession or have a soft landing. Stick with us. More ahead. This is Bloomberg. The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Now for some of our other top stories. Credit Suisse may report an additional losses of as much as $2.2 billion in the third quarter. That's according to the defunct bank's financial report for the first half of the year. Investors remaining optimistic about UBS's capacity to successfully integrate its former rival. Bank shares poised for their best quarterly share price gain in 14 years. Staying with European banks, Commerzbank says it intends to return a total of 3 billion euros to shareholders in the 3 financial years to 2024. This comes as the German lender details its long-awaited capital return strategy. Coming up on the program, we look ahead to today's Eurozone CPI data due this morning and focus in on Germany after inflation there sank to its lowest level in 2 years. Stick with us. This is Bloomberg. A diverging picture across Europe as French inflation unexpectedly slows. Euro area CPI is up later this morning, the next piece in the puzzle for the ECB. Now, the BOJ announces an unscheduled bond buying operation after yields across the curve climb to decade highs. Plus, its deadline weekend, the U.S. government shutdown draws ever closer, while over in Detroit, the UAW could expand its strike against its legacy automakers. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. Now, German Chancellor Olaf Scholz is downplaying fears of a potential trade war over the EU's anti-subsidy investigation into Chinese EVs. He spoke exclusively with Bloomberg at the Berlin Global Dialogue.
The economic model which I favor is to have a global competition. I'm very much in favor of globalization. I think it made it that billions of people left poverty, that many came up to middle class in many countries of the world, that many new cities had been built and will be built, and that we see new highways, new railways over the world, airports, hospitals, universities, schools, all these spreading up all over the globe, and this is a good thing. Our task must be that this is not just a part of the world, even if it's a big part, that our task must be to work for the whole world to participate from the chances of globalization and to grow and to have their own infrastructure and industrialization and things like that. And this would be also a much safer world, to say it. But the economic model, let's say, of Germany, but I think it is model that fits for the whole world, is that we are not working protectionists. We want to sell, to say it, our cars in Europe, in North America, in Japan, in China, in Africa, in South America, in all the places. But this means that we are open to get the cars of other countries also on the market of Germany. And I still remember what was it, the big debates that started when the Japanese cars came to Germany. No, they are part of the market, and there is now German cars in Japan and Japanese cars in Germany. What is the problem? And the same happened when the Korean became successful car producer, competitive on the whole world. They are doing a good job, and now there are German cars in Korea and Korean cars in Germany. What is the problem? And we should look on these things like this. It is the better alternative than the protectionist way.
German Chancellor Olaf Scholz speaking exclusively to Bloomberg. We have an Euro area CPI data hitting the terminal at 10 a.m. London time today after a reading of French inflation showed an unexpected cooling earlier this morning. Now, focusing on Europe's largest economy, Germany's inflation numbers actually dropped to its lowest level in 2 years, softening far more than expected. Bloomberg's Oliver Crook in Berlin is all over that story. Ollie, good news or bad news?
Yeah, well, a bit of both, I suppose. It shows that inflation is coming down, which is obviously good news for the ECB. This is sort of the intended effect. 4.3% is quite a bit better than the 6.4% we had the month before. That is in part because of the base effect from last September, where you saw inflation really jump up after the subsidy for transport in Germany was evaporated. The downside, though, is, of course, that this shows that the economy is perhaps slowing a little bit. And when you look at the risks going forward, you look at the energy sector. We've done 30% on oil in the last 3 months, but really also taking a look at gas as we enter winter. This is a key concern for Germany. And remember, there's still 25% of the original amount of Russian gas flowing into Europe that has not yet been cut off. And this is sort of something to keep in the back of your mind. And then also thinking about labor in Germany. So structurally, you have problems in the labor market here in Germany where you don't have really enough workers. But in the shorter term, IFO is saying that companies are starting to be a bit more reticent around hiring. So maybe some of that slowing of labor demand and perhaps will dampen wages a little bit as we end the year.
So a lot of doom and gloom coming out of Germany. Does that make them the sick man of Europe?
Well, this is the big question, right? This was a sort of Economist cover, and this is a big conversation here in Germany, and we talked to a lot of executives about this. And there's a bit of a mixed picture on that. Obviously, in the short term, there's the question of manufacturing. It's 20% of the economy here, and that has really seen a very strong slowdown in recent months, and really since July of last year, and been in contraction. And it's expected to shrink this year. Germany's by 0.6%, which is even worse than they thought earlier in the year. So all of that is pointing toward a downturn. Again, looking forward towards catalysts, one of the things that we're paying close attention to is China. Could this EV trade war escalate into something more severe? And how are German executives thinking about this? So I spoke to the CEO of Siemens Health, the CEO of Siemens Healthineers yesterday about the difference between de-risking and decoupling.
China is a huge opportunity for us. What is important is that the rest of the business, being able to deliver or being able to live up to the expectations of customers in the rest of the world, outside China, doesn't depend on China. So that's for me the topic, and we have also worked on decoupling, so to say, the supply chain, but we are extremely committed to further investing in China.
And so really highlighting how important this market will remain for this company, China that is, but really also trying to pull the supply chain out of it and try to insulate that a little bit. The other thing, Kriti, that we might want to pay attention to, speaking to these German executives, a lot of them are saying, and you're not going to find this in the price discovery, part of the issue here, the doom and gloom, is that Germans can be quite pessimistic and a bit self-deprecating. And a lot of these economic surveys are about sentiment, not necessarily hard data.
Pessimistic and self-deprecating. It's almost like you're in London. Oliver Crook in Berlin joining us this morning. We thank you. I'm going to stick with the story in Germany. Let's get to the Berlin Global Dialogue Forum, where Bloomberg's Danny Berger hosted a panel called The Global Economy in Times of Fragmentation. She had a great conversation with BlackRock CEO Larry Fink. Take a listen.
I don't know what is a new normal. I actually think every day is normal. The markets go up and down, markets move, markets respond to political issues, political uncertainties. But I would clearly say we are in a period of time with these mega cycles, we're in a period of time with so many transitions. Whether it's a transition from deflation to inflation, a geopolitical transition, and where does that go? The fragmentation of supply chains is just beginning. We have policies in so many democracies that have moved from policies that I would say were embedded for more deflation, and now the policies are more embedded in inflation.
Well, as we adjust to that, you have Jamie Dimon, for example, saying rates in the U.S. could go to 7%, and we're not ready for it. Is he right?
Look, we all have opinions. I mean, I've been saying for over a year.
I want to know your opinion, Larry.
My opinion is we're going to have 10-year rates at least at 5% or higher because of this embedded inflation. This structural inflation is unlike anything. And I think business leaders and politicians are not providing the foundation to help explain this. We have not seen inflation like this in over 30 years. Actually, I was a young bond trader during the late 70s and where we had hyperinflation. I don't think we're going to have anything close to this inflation of the 70s, but we have so much deeper structural inflation, and we are underestimating the change in geopolitics is so structurally inflationary. When I was in Davos earlier this year, I heard the phrase national security. uttered everywhere. And quite frankly, I never heard those phrases uttered that often before that in all my years. So national security for chips or food or energy, obviously energy, and all these issues. And the question is, at what cost? And nobody answers that question, at what cost?
Well, you said politicians, governments, they need to do a better job of explaining this, of talking. What would that actually look like?
Well, I mean, they have to recognize if we are going to focus on the whole idea about restricting immigration. Big topic here in Germany. Big topic in the United States. We are down in the United States close to 3 million legal immigrants. We've changed the immigration policy. At the same time, there's so many job needs. And in the United States, we've had close to $1 trillion of fiscal stimulus just beginning its J-curve. And these are huge job creators. And at the same time, we have restricted immigration. And as a result of it, we see more wage pressure. So at what cost? We have, in the United States, a very protracted strike between the auto workers and the auto companies. It has been reported that the union is asking for a 40% increase. So at what cost?
Bloomberg's Danny Berger there with BlackRock CEO Larry Fink making some really interesting comments about the bond market and the state of the entire U.S. economy. I want to get back to one of the major movers on the Eurostock 600. That, of course, is Commerzbank. Those shares higher by about 10.3% this morning. The German lender is saying it intends to return a total of 3 billion euros to shareholders in the 3 financial years to 2024. This as Commerzbank details its long-awaited capital returns strategy. So classic buyback pushes the stock up kind of announcement. Coming up on the program, striking auto workers in the United States say they want a 30% pay rise from Detroit's 3 major car makers. That story next. This is Bloomberg. The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Now, the United Auto Workers Union is saying they want a 30% pay rise from its strike action at Detroit's 3 major automakers. Joining me now is Bloomberg's Bill Ferries. Bill, this saga has been going on for so long. Are we any closer to a breakthrough?
Well, the hard answer is maybe. We'll get a lot more information from Shawn Fain, the president of the United Auto Workers, when he is expected to speak at 10 a.m. Eastern Time in the United States. But we have seen some progress in the sense that, the UAW's latest ask is they say that they want at least a 30% salary increase for their workers. That is down from, I think, an initial ask of about 40%. And we know Ford had come in at one point proposing 20% plus cost of living adjustments and other things. So the gap, I think, between the two sides has narrowed. But today will be a key moment to see if that strike in its 3rd week now expands to even more plants.
So they initially came out, I think the very first offer that they had was about 46% pay raise. And look, this isn't immediate. This is over the course of several years. But what is the latest proposal? How much farther lower from 46% are we talking?
So we're at 30%, but that's really seen, I think, by the UAW and its leadership as a floor. They want to see the big 3 companies continue to raise what they're willing to pay. And look at other adjustments. It's not just about the basic salary. This is about plans for future plants, EV plants. It's about retiree benefits. There are a lot of other issues in there. The union is really looking for progress on all those fronts. But when it comes to a bottom line number on wages, they say it has to be at least 30%.
So what happens then today? What is our worst case scenario? How does this play out?
Well, I think there's a couple things. We'll hear from Shawn Fain, the president, at 10 a.m. We'll find out if some talks that were happening late Wednesday, Thursday, if that if there's been any progress in those talks. We'll also find out whether there's continuing progress with Ford. Ford, as you remember, was left out from the latest escalation of the strike. If there hasn't been progress, if you're talking about a worst case scenario, the UAW could say, you know what, we're putting Ford back on the table. We're going to increase the number of Ford facilities that are facing strikes, and we're going to increase the number of strikes at Stellantis and General Motors facilities. So I think that's the worst case. Is you see progress talks breaking down, and workers at more plants, more auto facilities hitting the picket line.
Certainly a lot to digest. And I wonder what precedent they end up setting for the future labor movements that I'm sure are in the pipeline. Bloomberg's Bill Ferries, thank you for the update this morning. I'm going to stick with a major story that, of course, the U.S. government is watching. The recent debut of Huawei's high-end smartphone. Well, it could be a message to the United States that its tech curbs aren't really doing much to stop China from developing advanced semiconductors. At least that's the subject of today's Big Take piece. Let's get a little bit more with our Asia Technology Executive Editor, Peter Elstrom, joining me this morning. Peter, how big of a deal is this new piece of technology?
Hi, good morning. To understand the significance of this new phone that Huawei put out, it helps to go back a few years. Huawei is a very secretive Chinese company that a couple decades ago emerged as a very big player in telecom equipment. So they were competing with the likes of Ericsson and Cisco, and they very quickly became the biggest player in telecommunications equipment. And then after that, they went into the mobile phone business. And again, they grew very quickly, and they surpassed the biggest companies, Samsung and Apple, to become the biggest player in mobile phones. So the United States did two things that really wiped out their smartphone business. First, in 2019, the U.S. blacklisted Huawei, cutting them off from some of the key components that they needed. And then last year in 2022, the Biden administration implemented a whole series of export controls that limited the kind of semiconductors that could be sent into China and the kind of semiconductor equipment that could be sold into China. So when Huawei came out with this new phone, the Mate 60 Pro, in late August, it was not just the return of Huawei to the smartphone business, it's also a signal that China is much more advanced in semiconductors than many people had realized.
Well, expand on that there. Talk to us a little bit, for the folks who aren't really ingrained in the nitty-gritty of the chip world, what the SMIC chip actually is. Why do we care?
Yeah, so this SMIC is the Chinese company that actually made this chip for Huawei. And what the United States tried to do in October of last year to set up controls around the Chinese semiconductor industry, which is sort of the foundation of the technology industry, so that it could not get as advanced, it could not get close to the sophistication that you see in the U.S. or other countries around the world. The goal was to hold China back to about 8 to 10 years behind where the United States was. And when we saw this latest chip in the Huawei phone from SMIC, it turns out that they now appear to be about 4 or 5 years behind where the U.S. is. Now, there are a lot of questions still remaining. It's not clear whether SMIC can make these chips in volume. It's not clear exactly how broadly they're going to go within the economy. Nobody really cares about whether advanced chips are going into smartphones. If there are sophisticated smartphones in China, that's not the big deal. The big issue is whether these chips can then be used in applications like artificial intelligence or supercomputing, and especially military applications.
I mean, it's a fascinating dynamic because, of course, as you're seeing these technological advances, I mean, there's healthy competition on the one side, and then there's the geopolitics between the United States and China. Peter Elstrom, our executive editor for Asia Technology, breaking that crucial story down for our European audience. We thank you for joining us this morning. Coming up, we go right back into the markets. The S&P 500 heading for its worst month since December of last year. Valerie Teitel has your markets wrap next. This is Bloomberg. The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. I want to get a quick recap of some of the major market movers on the Euro Stock 600 today. A lot of them coming from Nike's earnings overnight in the U.S. session. Simply the idea that Adidas, Puma, JD Sports taking their cue, I suppose, from Nike's massive profit beat. They're basically saying that, look, the inventory issues of the last 2 years is getting a little bit easier, putting a little bit of growth on the margin story, where something that, retailers around the world have felt a lot of pressure for. That's just one story we're going to be following in the session. The others has to do with the global equity picture. Having been rocked this month, the bond market not really pretty either. Let's get a little bit more on the markets with Bloomberg's Valerie Teitel. Valerie.
Oh, look, that's exactly it, Kriti. It's been a big month, not just for the equity market, but for fixed income markets as well. For the S&P 500, we are headed for the worst month of the year. The S&P index is down some 4.6% this month, on track for its worst month since December 2022, all down to this rout that we've seen in treasuries. In my next chart, we can zoom in on just how big it was. In the 10-year and in the 30-year yield, both of these rose over 50 basis points in September alone. This has really been the key to what's driven the dollar strength, to what's driven these equities to be in the red for the month of September. I've got a circle here on August 1st. That was when the U.S. Treasury first announced their larger auction sizes and that we were issuing nearly $1 trillion of treasuries this quarter. You can see we've been nearly on a one-way track for higher yields, lower bond prices since that extra supply was announced to the market. But it's not been only in the Treasury market. We've had a global repricing when it's come to yields. Not only have treasuries hit cycle highs across the curve, but we've also seen German 10-year yields be rocked as well, hit the highest levels since 2011. We also saw that spread widening happen between Germany and Italian debt as well. And then over in Asia, we need to mention what's been going on there. The 10-year, the 20-year, and the 30-year all rose to decade highs. And if we actually look on Japan on a quarterly basis, they have had the worst rout in JGBs in 25 years, Kriti. It's been a monumental quarter for the bond market, for treasuries, for Euro govies, and for gilts, and for Japanese bonds as well.
A lot to digest there. And of course, as we know, the shutdown is looming. That always creates a little bit of volatility in the bond market, even if it is short-lived. Bloomberg's Valerie Teitel, we thank you as always. Now, if there's bond volatility, the first thing that comes to mind is simply that the idea that some of the banks may actually profit off that volatility. When speaking of those banks, Commerzbank is the biggest riser on the Euro Stock 600 this morning. The German lender says it intends to return a total of 3 billion euros to shareholders in the 3 financial years to 2024. This as they give long-awaited details on their capital return strategy. Now, looking ahead to Monday, we'll speak exclusively to JP Morgan CEO Jamie Dimon. He is here in town for a tech summit. You do not want to miss it. Up next for now, the Bloomberg Brief. Danny Berger in Berlin, Manus Cranny in New York. This is Bloomberg.